Lululemon has crashed more than 44% year to date, right now trading at a new 52-week low. Despite that, we get a double buy rating, and as we're about to see, there is massive upside with this company. Now, a few things to note in their latest earnings. In fact, just from last month, it did pop. However, what we did see was that unfortunately they did issue weak guidance for the next quarter, so that is quarter 2, with one of the reasons being the slowdown in the Americas. Now, this is their largest market as well, and one of the interesting things to note with this company that is down significantly, in their latest earnings, they actually performed very well. As we're about to come on to see, this is a common theme with this company, both on the EPS and on the revenue, they did beat. Now, that is always a great sign. But one thing we do also want to point out, not too long ago, in fact, their chief product officer did resign, one of the reasons why we did see that share price tumble year to date. And one thing that is very interesting, maybe it would have gone past your information, but what this company has said is that they are not looking to replace the CPO position. On top of that, yes, Nike earnings is relevant to this company. One of the reasons why Nike in fact has fallen was that they are talking about lowering their guidance, which they did in fact do, they cut it. And one of the reasons they mentioned in their call was a slowdown in lifestyle sales. Now, this is something that you can also attribute to Lululemon. Is there a slowdown in their sales as well? Well, not something that we've seen quite at the moment. And again, we are going to take a look today. Now, a few things why we like this company. Free cash flow, very important. We want to see growth on this number consistently over the longer term. That is what we get. 2015, $135, 2024 at $13. Now look, over the next 12 months, this isn't expected to slow down. $14.70 is the anticipation. Therefore, that upward trend is expected to continue. We then look at their sales growth. Now look how gorgeous this is. We are talking about double-digit increases every single year. Even in the more recent year of 19%, this share price has been slaughtered down 45%. So again, very strong reasons on this channel. We do like to look for value. Let's find out as we go along whether or not we are having a golden opportunity with Lululemon Athletica. Another thing to note, when we do look at the numericals of their total sales, we can see that lovely growth year on year. Again, something that is very important to any company you invest in, not just increasing revenues, but also margins that we're about to look at. And whilst we love it when companies return excess cash, we can see over the longer term they have done this, although fairly trivial, so not much to discuss. Now, ROIC, honestly, this is one of the most beautiful graphs we have seen. We're talking large double-digit numbers across the board. We just want a minimum of 10% here. Just give us faith. Management are able to effectively allocate their capital. I mean, just in the last 3 years, in the high 30s, the low 40s, looking very, very strong. Something that investors will find incredibly attractive. Margins, now we just briefly touched upon that. With companies, we want to see increasing margins. We do see that with Lulu, although it is fairly trivial, going from 21 to 23. But what is nice to note, it is above that minimum of 16% that we want to see in any company. And the free cash flow margin are minimums at 5% level. We can clearly see this is very, very strong. Granted, it did drop in 2023, but what's very important to understand with companies, when we have metrics that do fall very dramatically, always good to see that they do rebound very sharply. So again, another added bonus. Now look, this is absolutely gorgeous as well. I know we've said that a few times today, but on the net debt to EBITDA, for those that are regular viewers, you know that this metric correlates to that balance sheet strength. What this effectively means, it will take them less than 1 day to pay off all of their debt net of cash on hand. A phenomenal balance sheet. And again, we are going to look at that in detail very shortly. Now, before we do look at the numbers, what we do want to go through is their historical performance. Year to date, negative 44%. Over the last 10 years, though, what is very nice to note, even with this massive drop year to date, they are up 646%. And what this indicates to us is that you would have outperformed the S&P if you held onto this company by quite a significant distance as well over the period. Now, as we mentioned, they are trading right there at their 52-week low. We do get a double buy rating, seeking Alpha Wall Street where they hold from Quant, and we can see the forward P sitting around 20 level. Now, bear in mind, the S&P, for those that like to compare, is sitting around 23. Now, what we want to have a look at very quickly in terms of that top line revenue, but also their bottom line net income, 1.8 billion, and in their more recent annual accounts of January 2024, 9.6 billion. So graphically, as we already saw, this is just another format. It is moving in that right trajectory, and we're going to take a look at their latest investor presentation shortly as well. What about the bottom line? What story can we see there? Well, 239 million in 2015, 1.6 billion in January 2024. For the large part as well, with that top line revenue, we also get that bottom line increase over the longer term. Some years we do see a drop, but overall it is moving in the right direction. Things we really do love to see, not just top line increases consistently, but also the bottom line net income. As we already mentioned, they have a phenomenal balance sheet, so let's have a very quick look. We're doing a cash versus total debt assessment for the health of the company. 665 million in 2015, 1.9 billion in the latest quarterly report. So similar to the other metrics, over time it has been increasing. Just remember that if you are looking at any of your own companies, purely in isolation, cash will not tell you anything, which is why we compare it to their total debt. Look, zero debt in 2015, 1.4 billion. As we can clearly see, their cash is larger than their total debt, so a very strong balance sheet, as we've already mentioned, something that is always great to see. And ideally, you do want to invest in high quality companies. One of the ways to tell will be that essentially the net debt to EBITDA is very low, zero like Lululemon ideally. Keep moving then, we get to the earnings per share. How have they performed historically? What are projections moving forwards? Well, look, again, 4 beats over the last 4 quarters. That is a 100% track record. Moving forwards, what are we looking at here in their next earnings? Double-digit increase to the earnings per share year on year. Next quarter, double-digit earnings increase. Again, that theme of double-digit increases to the earnings per share looking very glorious. And if you have faith in their estimates, well, look, forward P based on the earnings per share of January 2026 will be around 18. Again, that does look pretty attractive for a company that is increasing double digits on their top line. Again, that will be the assumption if you believe that moving forwards as well. Now let's take a look at the valuation. They get a D, so let's take a look and see why. In terms of the P on a non-GAAP basis, well look, it's around 20 at the moment, so one of the reasons we are seeing the sector as a whole is trading at a massive discount, 14.93, so a 35% discount. But remember, your alarm bell should be going off. There may be reasons why companies trade at a discount or why they trade at a premium like we see with Lululemon. Are there other areas that this company outperforms the sector? In terms of valuation, though, the theme is there pretty much across the board. Any metric you look at, they are trading at a premium to the sector median. We then move on to the growth grade. Now they get a C+, so we'll understand why that is, because on the revenue year-on-year growth, 15.65%, a lot better than the sector median. Forward looking, look, 13%, that is very strong. Sector median at 3.81, so I would personally disagree with this C+. One of the things that we do like to look at, we can see the earnings per share over the next 3 to 5 years, compounded annual growth 11.24, marginally higher than the sector median at 10.97. I don't think that is fair to give it a C+ as well as a C+ overall. So I would say their growth does look very, very strong in comparison to the sector, and we can see here just on the percentages a lot better. Now let's take a look at their profitability. In terms of that, well, they get an A, so nice to see one area that they do really shine through. Gross profit margin then 58%, significantly better than the sector median. Bottom line net income 16% above that 5% from the sector. Now, one thing you also need to understand is, yes, historical data, lovely, they've been performing gloriously, etc., but can they sustain that? That is the main question, and something we're going to come on to when we do look at that essential margin of safety. Cash from operations finally as well, blowing them out of the water, 2.4 billion versus 279 million. Quick conclusion, this part of the analysis, well, a double buy rating, the hold from Quant, valuation D, growth C+, profitability A. Then we move on to understanding the general theme of the industry and Lululemon. Is there a reason why this company is performing poorly? Is it something we can identify in the trend? We have others in here. We have Adidas, Kering, Ralph Lauren, and lots of those that are very well known. And over the last year, well look, Lulu is in fact down negative 23%, but we can in fact see 4 out of the 6 have performed very, very poorly. So you could say that essentially in this industry, similar to, for example, if we had a Nike, that would have shown a very poor performance. There is an issue with consumer demand lowering, or maybe they are looking at cheaper alternatives. How about over the last 5 years? Well, we can see, in fact, they are one of the better performing up there in terms of the top 4. We essentially see 53.3%. Now, if you zoom back to the last 10 years, if you had invested in this company, you would be up 648%, very, very strongly. But again, past performance doesn't mean anything when we do look at our future projections. Do bear that in mind. We then look on to the famous age-old question that if you are expecting to invest in a company, make sure you have that confidence that it will outperform the S&P. Otherwise, just invest in a low-cost ETF. Look, over the last 12 months, it has underperformed quite significantly. Over the last 5 years, again, underperformed. Over the last 10 years, no question whatsoever, it has strongly outperformed, which is always good to understand not just whether or not you have that confidence, but also what is your investing time horizon. Are you looking at just the next few years? Are you looking over the next 20, 30 years? Add that into your own investment thesis. Now, before we move on, let's just have a quick look at insider movement. Ownership, fairly small, 0.8%. We do see 32 million worth of sales over the last 12 months with a very trivial amount of buying in comparison. The main thing we want to flag here, in quarter 3, there was no movement by insiders. Quarter 2, again, none. In fact, the more recent insider movement was buying in quarter 1. You'd have to go all the way to quarter 4, where insiders sold around 21 million. Now, for those that are interested to understand who these insiders were, even though it was going back quite some way, you can in fact see the CEO, Calvin McDonald, on the 18th of December sold 25,000 shares, significantly higher than the current trading price. For me, this isn't a bearish indicator. 1, it is a bit outdated, and 2, they sell personal or financial reasons. Institutional ownership, well, just above 85%, 5.4 billion worth of sales by the institutions over the last year, a lot more buying, 5 times over the same period, and we can see in the more recent quarter, double the amount, or nearly in fact double the amount of buys than sells, or as we can see the previous quarter it was the other way. Regardless, institutions buying, selling, whatever they're doing, same with insiders, always do your own due diligence. Now, we do just want to let you know we have released our latest free weekly article. You can read this by clicking on the pinned comment below, sign up, and comes with this article a free spreadsheet that runs through all of the dividend kings. 18 of those we do see as undervalued, and as always, this will give you access for free to all of these other articles. Now, before we jump into the valuation, their latest earnings, a few things that we just want to highlight. In terms of comparing to the same quarter last year, well, total revenue up 10%. Love to see that double-digit increase. Diluted earnings per share up double digits. Again, very nice to note. Their total comparable sales, as we can see, high single digit. They also talk about some of their new product innovations, and we can see for both the women's and the men's revenue, nice double digits. Now, finally, just the only thing that we do want to point out here is that when they do talk about that market expansion, they really see a lot of growth in that international revenue, plus 35%. Was one of the areas that they were a bit disappointed in when they were looking solely at their largest market, but there could be the room to grow in the international space, as we can see, plus 35%. So let's jump into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $407, the reason how we got to this number, we use the discounted cash flow model. Now, we have the free cash flow year on year, the average growth of 19%, and our discount rate. What we typically do on this channel is we have a low, medium, and high rate for essentially this model. We've gone for a 15, which is in fact below the average of 19. We've gone for a medium of 20 and a high of 25. These are the values that it would derive. For example, if we just put in 25, so you can just see that clearly, it would give that $580, which would mean that right now, if you see their free cash flow growing at the 25% level, you will double your money with this company. Now, what we typically do is we use the medium rate, but today, rather than using 20, we've pretty much gone bang on with that essential average growth rate of 19%. With that, we see massive undervaluation. So what we do is we take it through to the next slide. We have the current price at 283, and we use a margin of safety as always. We start off with 10%. Now look, 10% if it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for today, well look, it is a buy up to $366, so that would mean an alarmingly yes on that buy button. And then we move on to the 15%, again, still a buy, showing some very nice MOS in today's episode. In fact, at the 30% level is where it is sitting at now. So if you believe over the longer term, this is a company that will be able to continue to increase their top line, whether that is through the expansion into the other areas, not just into their largest market, Americas, they can continue to increase their margins, then right now a 30% MOS level is a massive buy signal. But as always, you do need to consider whether or not maybe consumers are starting to slow down in their purchase products. In terms of Wall Street, well look, they believe there is massive upside, one of the best upsides on the market right now at $409. Now right now it doesn't currently pay a dividend, but look, right now if you're talking about a company with massive upside and massive margin of safety, then it could definitely be one to consider for those that specifically like dividends. As always though, do let me know your thoughts below. Is this one maybe you're looking to consider? Maybe it's not one, it's on the watch list, still hoping it will come down lower, or maybe this doesn't pay a dividend so it's not on your radar at the moment. As always though, if you have enjoyed today's episode, smash that like button, hit that subscribe and bell button. You can also grab a copy of this model by clicking on that pinned comment below. And as always, we'll see you all on the next one.